Welcome to episode 16 of the SaaS Report. I'm your host, Matt Aird, founder at Sales Science, and we're back from a mini hiatus. We've been neck deep in operations over the last few months, but I'm really excited to get stuck into the episode today. We're going to be looking at Q1 earnings from Workday, Snowflake, Palo Alto Networks, and Zoom. We're then going to take a look at Salesforce's acquisition of Informatica for $8 billion. Then we'll take a deep dive into how we're using AI in go-to-market at the moment and some of the other opportunities that exist in that space. And we'll close out by looking at Crunchbase's Q1 report on venture funding, private market tech, and M&A activity. So let's get stuck in. So Workday reported Q1 earnings recently, and the metric that jumped off the page immediately was the fact that they had a 120-month CAC payback in Q1. They spent about $630 million on sales and marketing to generate just $76 million in net new ARR. This is a massive blowout compared to Q1 of last year, and if you even look further back, a massive blowout in all of the company's history. As we can see on this chart, they've consistently sat at around a 30-month CAC payback for the last few years. And then boom, right, this massive blowout in Q1 of this year up to 120 months. They did have a slight outlier in Q1 of last year as well. So this could be some seasonal variability, but it's something that we'll take a close eye on when they announce Q2 earnings later this year. Year over year numbers are a bit better. ARR grew 13% to $8.2 billion. Interestingly, spending on R&D dropped. So in Q1 of last year, they were spending 33% of revenue on R&D. That's dropped to just 30% of revenue in Q1 of this year. Most of this reduction is likely tied to the layoffs that they announced in February. So Workday announced plans to cut about 1,700 jobs from the company. So looking at the numbers here, it's likely that a lot of those jobs were in kind of the R&D, software development, software engineering space, as we've seen with other companies that have announced layoffs recently, right? The likes of Salesforce, Microsoft, and others. Spending on sales and marketing was down slightly as well, down to 28% from 29% in Q1 of last year. They generated $421 million in free cash flow for the quarter. That was about a 19% free cash flow margin, and continued to report really strong gross revenue retention numbers. So that came in at 98% again, which basically means they churn no customers year to year, right? This has been one of their strong points consistently over the life of the company. It seems that once you buy Workday, you're not really swapping it out for anything else. They've got a market cap at the moment of about $64 billion, or about 8 times Q1 ARR. Zoom reported Q1 earnings as well recently, and they generated $2.43 million in after-tax profit every single day in Q1. They're just a cash flowing machine at this point. Free cash flow came in at $365 million for the quarter. That's up 26% year over year. $219 million in net income. That's up 20% year over year. But absolutely anemic growth. So ARR growth came in at just 3% year over year. So despite spending $358 million in the quarter on sales and marketing, they generated only $86 million in net new ARR. Now, this is one of the craziest charts that I've ever put together. What we're looking at here is Zoom's year over year ARR growth rates for the last 4 years. And what we can see here is this massive drop off, right? So from Q2 in 21, they were growing at about mid 50%. That has just absolutely fallen off a cliff and has been trending in the low single digits now for the last few quarters. In the middle of the pandemic, growth rates got as high as 370% for Zoom. That was in Q1 of 21. But despite the growth struggles, right, they're just a wickedly efficient business at this point, if we're looking at them from, an operating margin and a free cash flow margin standpoint. But they really need to find the next growth driver. Video conferencing is saturated. You can get tools that are just as good now, basically for free. And without a clear strategy here, the share price is just going to continue to trade sideways. They're trading at 4.5 times ARR right now. Palo Alto Networks generated $1 billion in net new ARR over the last 12 months. For Palo Alto Networks, the way I'm calculating that is looking at subscription and support revenue. That came in at $1.8 billion in Q1. They also had $450 million of what they call product revenue in Q1 as well. So if we annualize total revenues from them in Q1, that puts them at about a $9.2 billion run rate. And when you look at this annualized revenue chart, it is a thing of beauty. Slow and steady up and to the right, growth ranging from kind of the low 30% in 2021, trending down to the high teens. Now, as a company, you expect that growth to tail off, right? As subscription revenues grow, or as revenue grows, it becomes harder to generate those high rates of growth. So you expect to see some slippage there. but Palo Alto Networks has done a great job of maintaining decent growth rates, right? Being at $9 billion and growing just under 20% is a massive achievement. So safe to say they're one of the juggernauts in tech at this point. Total revenue was up 15% year over year. Free cash flow margin came in at 24% for Q1, and they reported $218 million in operating income. That was up 24% year over year. They've got a market cap of $125 billion, or about 13 times revenue. Snowflake reported Q1 earnings recently as well, and they are just completely bucking the trend of most of the SaaS companies that we track. While every other company is trying to move towards kind of fiscally responsible growth, right, moving to operating income break even or operating income profitability, Snowflake is moving in the complete opposite direction. They delivered a negative 43% operating margin in Q1. So that was a $450 million loss on $996 million in revenue. And if we look back over the last few years, they certainly haven't been shy about losing money. They've scaled losses from about $150 million in Q3 of 22 all the way up to $450 million in Q1 of this year. Right, and as I said, that is just completely against the grain of what most SaaS companies are trying to do at this point. And so if you're going to do that, you need to be able to generate top line growth. And Snowflake's delivering here. ARR growth came in at 26% year over year in Q1. That puts them kind of firmly in the top quartile of the SaaS companies that we track. And one of the big drivers here is the insane net revenue retention rates that they're able to drive. NRR came in at 124% in the quarter. That's much higher than the median of 110% that we saw for the basket of companies that we track in Q4 last year. And despite the large operating losses, they do generate really strong free cash flow margins. They had 18% free cash flow margin in Q1. And a big reason for that, so why there's a large delta between operating income and free cash flow margins, is that they pay an absolute shit ton of stock-based compensation. They paid out $408 million in stock-based comp in Q1. You compare that to DocuSign, who is at about a similar run rate. They paid out only $150 million in stock-based comp in Q4 of last year. Go-to-market efficiency metrics for Snowflake are pretty middle of the road at this point. 34-month CAC payback, 0.49 on magic number. Both are just slightly worse than Q1 of last year, but really strong RPO growth. So remaining performance obligation jumped 34% year over year. And so that's a really good sign for continued ARR expansion moving forward. Snowflake's valued at about $68 billion, or around 17 times ARR at this point. All right, first major kind of news item for today is Salesforce's announcement that they're going to acquire Informatica for $8 billion. Now, I didn't know much about Informatica before this deal was announced. It's not one of the companies that we've tracked quarter to quarter. So for those of you in the same boat as me, Informatica sells what they call an ETL, or an extract, transform, and load platform. Companies use the software to move data between different applications. And one of the main workflows that Informatica customers use the platform for is for getting data from third-party systems into Salesforce. And so the idea behind this acquisition is all about improving Salesforce's Agentforce's product, right? Improving their access to data. So according to Salesforce, Informatica's ability to retrieve data from external systems will help Agentforce, AI agents, find the information they require to answer user questions. The company also sees other benefits. Informatica's platform collects metadata about the records, including where those records were originally stored and how. This metadata can help AI agents more accurately interpret the information they process. So the idea here is, look, Salesforce is going all in on Agentforce, right? This is the future of the company. This Informatica acquisition allows them to improve the capability of that Agentforce product, right? Not all of the data that their customers need live inside Salesforce at the moment, right? It's split off into other systems, whether that's ERP, whether that's human resource management systems. And so Agentforce needs to be able to get access to that data, and Informatica is going to enable their customers to get that. So the more control they have over that platform, the better they can make their Agentforce product. So we got Informatica's Q1 results just before this acquisition was announced. Pretty average, to be honest. So they had CAC payback of 135 months over the last 12 months. Pretty choppy revenue growth over the last 4 quarters as well. So that was, 7%, 3%, negative 4% in Q4, and then 4% revenue growth growth in Q1, but cloud revenue was growing strongly. So they were businesses transitioning from kind of on-prem to cloud subscription-based business. That cloud business was growing 30% year over year, with the average customer spending about $350K per year with them. Cloud net revenue retention rates are really strong as well. They came in at 120% for Q1. So some good signs of strength in that kind of cloud subscription business. Salesforce is making the buy at just under 5 times Q1 revenue, so revenue run rate. So the deal, it should be accretive for Salesforce from the outset, right? Salesforce trades at about a 50% premium to Informatica. So basically what that means is that the income and the revenue that Salesforce gets to tuck in will get a premium placed on it, meaning that Salesforce effectively acquires that revenue at a discount. That should push up the price of Salesforce if they're able to maintain their multiples. Right, so all in all, shareholders should be better off from the acquisition. Over the last 5 months, we've been neck deep exploring how AI can assist us in our go-to-market motions. And one of the, I guess, the overarching themes that we've arrived at is that we're looking for opportunities where AI can help us to do things that we know we should be doing more of or more often, but we're not getting to as regularly as we should, right? As opposed to using AI to replace the tasks that we're doing as sellers or as marketers. So I think the easiest way to conceptualize this is through 2 examples. So at the moment, AI isn't very good at cold calling a prospect and being able to navigate that conversation into booking a meeting, right? And that's an example of something that reps are doing day in and day out and do pretty well. But what AI is good at is doing pre-call research to be able to identify a specific item of relevance or a specific kind of item of personalization that that rep could use within that talk track, right? And that's an example of something that, you know, sellers should be doing, but often aren't doing it regularly enough or aren't able to do it at a scale that makes it kind of like sustainable, right? Reps can't just sit there all day doing pre-call research before they make cold calls, right? Because you end up researching all day and not actually speaking to anyone. Now, I think the reason why AI is more impressive at doing the stuff that we don't do often or that we don't do enough of is because the bar is lower for that kind of activity. And the reason for that is that if you do something at, let's call it like 75 or 80% proficiency level, but you do it consistently, you're going to get good results. Right? Or at least you're going to get much better results than if you did something inconsistently, but with 95% proficiency. And so the majority of the use cases that we're really digging into and trying to explore are those areas of things that like we know we should be doing more of, or we wish we could do something, but it's just not practical to do it as a human or as a go-to-market team with limited resources. So let me give you a couple of really specific examples in how we're using AI at the moment. And the first one is using AI to generate a personalized talk track for a cold call, right? This is kind of the classic example in sales, right? Like if you said to someone, go and develop a custom talk track for each person that you're going to cold call, right? Now, if you did that, you're probably much more likely to generate better results from those cold calls, right? And what I mean by that is like, if that was practical and you could do it in a way that meant you could still make the same number of calls, you're probably going to get better results. The problem up until now has been that that is like completely impractical, right? You can't have an SDR sitting there all day spending 95% of their time doing pre-call research and 5% of their time dialing because they're never going to speak to anyone, right? With baseline connect rates around 4 to 5% in the US, or even 10 to 12% in Australia and New Zealand, you're going to spend just way too much time doing research and not enough time actually picking up the phone and speaking to people. But AI now makes that possible, right? We can use tools like AI SDRs, not to do the outreach for us, right? Which is an example of like replacing the human, but using those tools to conduct kind of that pre-call research or using them to generate a personalized talk track that a human SDR can then use in that conversation with a prospect, right? So you can upload a bunch of prospects, get the personalized talk track or the relevant kind of like insight personalized to that person, and then pipe that information back into your dialer so that when you connect with a prospect, that information's sitting there and you can use it on that call, right? This is a perfect example of stuff like we couldn't do this before AI, we can do it now. And this is something that we're going really deep on at the moment, testing across a couple of campaigns to see if it drives better results. The second thing that we're really exploring is how we can use AI to segment our TAM lists or our market maps into kind of much more specific and granular, ICP segments, right? So before AI, the way that all of us built these ICP lists was to focus on like really high level firmographic data, right? Things like what industry is the company in? How many employees do they have? What location are they located in? Things that you could set up on LinkedIn Sales Navigator filters, right, to be able to help you produce a list of target accounts that you might want to chase. Now with AI, right, we can make much more granular lists based on harder to find information, or at least information that isn't searchable in something like a LinkedIn Sales Navigator, right? 2 examples of this, of how we've done this on client campaigns, right? One of our customers sell a construction management platform to building companies, right? But their core ICP are builders that do insurance work, right? So not just general builders, but builders that specialize in doing, restoration projects for insurance companies, because they have specific kind of requirements that they need to fulfill both to the client and then to the insurer as well. Now, insurance builders isn't a category that you can search inside of something like ZoomInfo or inside of LinkedIn Sales Navigator. But what we can do is we can use AI to go and visit each one of the building company websites and uncover whether or not they talk about doing insurance building or restoration. And so that then allows us to go from this really broad list of, building companies to a much more specific list of building companies that talk about the fact that they do insurance building services. Another example is one of our customers sold kind of an inventory management system to food and beverage manufacturers, right? But only to food and beverage manufacturers that sold wholesale, right? So not ones that only sold retail through their own storefronts, but ones that sold wholesale. And so what we were able to do is to, again, build a list of food and beverage manufacturers or hospitality businesses, and then go and visit those sites using a Clayagent to uncover, do they talk about wholesale? Do they talk about stockists on their websites? And if they do, right, then they fit into this much more kind of narrow bucket for us, which is they're selling wholesale, they're a good target for our customer. All right, so those are 2 specific use cases of how we're using AI at the moment to improve our go-to-market motions. There are a couple of other areas that we're excited about investigating, but haven't kind of gone too far down the path yet. And the first one is kind of this idea of being able to use AI to be able to put together a much more granular and specific ICP profile, right? So we often work with companies that have grown, somewhat organically. They may have grown through inbound, they may have grown through referrals, and they've got a decent number of customers, but they haven't really tested the waters yet in terms of going outbound, right? And so we can look at an existing customer base and try to get some of that high-level firmographic data around what's a good fit profile for a customer. But what would be really interesting is if we could use AI to help us identify some of the things that aren't as obvious just by looking at that list of customers or that list of companies, right? And what I'm thinking about here specifically is things that are quite hard for humans to join the dots on, right? Like, is it that the people that bought from us, did the economic buyer have a certain personality type, right? Does the personality type of the economic buyer influence whether or not, we get a deal done? Does the tenure of the champion that we have in that deal, does their tenure at the company impact our ability to get a deal done, right? Like, is there a way that AI can kind of analyze a broader set of data to help us figure out, what are the other kind of intangible elements that help us to determine whether or not we have a good shot at being able to close a customer or potential customer or not, right? And again, it's things that are just too multivariate or too time consuming for humans to be able to go out and try to map manually or on a one-to-one basis. So if anyone knows of a company that's working on this, or if anyone has a good workflow that helps to identify some of those kind of second tier things, or some of the interesting elements of providing an indication around, likelihood to close score, hit me up. I'm really interested in exploring that use case in more detail. The second one that we're thinking about that we want to explore in more detail is next best action recommendations on managing kind of complex deal cycles, right? So can we train an AI agent to be able to surface the next best action that a seller should take based on the progress of the deal to this point, and based on all of the historical kind of deal data that we have in our CRM, right? So not just working off of a static playbook that says okay, after the demo, try to get POC approved. Then after the POC is approved, try, not a static playbook, but more so specific recommendations based on things like who we have engaged in the deal at the moment. What was the sentiment on the calls? Were there any specific objections that were raised? Is the tenure of the person that we're working with, does that mean we need to get someone else involved in the deal sooner? Again, right, it's not just the stuff that's easy for a human to do, but it's is there a deeper level of analysis that AI can help us to conduct to allow us to figure out, okay, what is the next best action that we need to take on this deal in order to give it the best chance of progressing through our pipeline? If anyone's working on that, right, hit me up. I'm all ears. This is something else that we're really excited about, AI being able to help sellers just improve kind of the velocity of the deals through the pipeline. Crunchbase released their Q1 State of Startup Investing report, and the overall sentiment is that it's mixed, right? Not great, not bad, like kind of somewhere in the middle. If we look at the headlines, it looks like startup investing is gaining momentum, right? In Q1 of 25, investment totaled $113 billion. That's a 17% gain quarter over quarter, 54% year over year gain, right? Which is like, you read that headline, you're like, fucking awesome, right? We're back on track. We're off to the races. Private markets are picking up again, right? But you dig in and pretty soon you see that 1/3 of that total was thanks to a single round. And that was OpenAI's kind of $40 billion raise in Q1. So without this deal, global venture investment would have been flat year over year, down quarter over quarter. And this helps to highlight kind of like one of the trends that we're seeing here, which is this disproportionate impact of kind of mega deals on the funding landscape, right? Which I think is kind of like the overall theme or the key takeaway that I would provide from this report, is that like more money is going to these larger kind of like mega rounds, less money being allocated to kind of like risk on, seed or Series A type bets. And when we look at the data, right, we can see this pretty clearly. So global early stage investment fell to 24 billion. That's the lowest level in the last 5 quarters. Seed funding saw a 14% year over year fall to 7.2 billion. So again, this continues the trend where larger established startups secure more funding. Younger companies set to face greater challenges in terms of access to capital. There's also a pretty big geographical tilt here as well. So for those of us in the APAC region, the news isn't great. This was the weakest quarter for venture investment since 2014 in APAC, with only 13 billion going to VC-backed companies in Q1. This is a 40% drop from Q1 of last year and a 25% decline from Q4 of 24. They say that the decline was largely driven by a slowdown in China. VC investment almost halved to 6.5 billion. This is attributed to the country's own economic slowdown and then impact of uncertainty due to rising trade tensions with the US. Crunchbase also gave us some news on the M&A front. Some good signs of life here. So Q1 was the strongest quarter for startup M&A dollar volume since 21. So that totaled 71 billion in exit value. There were 550 global M&A deals involving venture-backed startups, 26% increase compared to Q1 last year. Notable deals include Google's planned acquisition of Wiz for 32 billion, which if finalized would be the largest acquisition of a private company ever. So there were 12 acquisitions above $1 billion for venture-backed startups in Q1. And as we just reported before, we kind of saw this trend continue into Q2 with Salesforce's announcement of the $8 billion acquisition of Informatica. So what's ahead here? There's a little bit of talk in that article about IPO markets potentially opening up in 2025. I have my doubts. Like if you just look at the rest of the tone of this article here, what it says is that mature, kind of successful, late stage private companies have more access to capital than ever. And if I'm sitting in their shoes, it's like, well, why would you go public if you're a company like Stripe, right? You've got access to more capital than you could ever want. You can generate liquidity for your investors and your employees through private rounds, and you don't have to put up with the distractions and the volatility that comes with, being a public company. So do you want to IPO? I mean, maybe at some point, but the trend is pretty clear here, right? These successful kind of private tech companies are staying private for longer because they can. Right? They can get access to the capital that they need. They don't need to IPO in order to continue to get access to that liquidity for early investors and for employees as well. So that's it for the episode this week. It's good to be back. If you enjoyed the show and you want me to do more of these, please let me know. I've got planned in the schedule to do one every week for the next 4 weeks. So if you want me to continue past that, let me know. I do enjoy doing them, but it does take a bit of time. So any feedback there would be great. If you're watching this on YouTube, please like and subscribe. We're seem to be stuck around this like 180 subscriber mark for a while now. So give us a little bump, see if we can get to 200. But yeah, thanks for tuning in. I'll see you next week. Until then, goodbye.